for this session. And then also just wanted to remind everybody, please go ahead and put questions in the chat and the Q&A. You've got some great experts and decision makers and CEOs here for this particular session. And I'd like to reintroduce Nick. Why don't you reintroduce yourself and introduce the remainder of your panel?
Yeah, you bet. Thanks, Kevin. Good to be back with everybody. The morning session was really, really good. And this one will be a little bit more informal. I've known both these founders for a very long time. I'm actually on both their companies' boards of directors, so they have to be pretty nice to me usually. But these guys have both created really interesting companies. So I'm going to introduce each of them and then turn it over to them and let them kind of talk about their company for a little bit. And then we've just decided I didn't prepare any questions for them. We're just going to kind of have a discussion and throw some issues out there. So they're going to get hit with questions for the first time during this. So this should be pretty interesting. So, Dustin is the founder of Surify, and he's the son of a insurance agent. So he looked to go fix the whole industry. So I'll let him tell you about that journey here in a little bit. And then Max Drucker is a kind of serial entrepreneur I've known for many years. Met him when I was insurance commissioner. He had this big idea about transforming the commercial industry with automation and data, and has been really pulling it off and done a great job of building products that the industry needs. So I'll let him talk about Carpe Data after Dustin kind of gives you a high level of Surify. Then we're just going to start with questions. And again, if you have any, just put them in the chat and we'll answer those too. So Dustin, why don't you go ahead, give a little bit of an overview about Surify and how you kind of got to where you are now.
Yeah, no, the background there too is that I was pinging Nick. So Nick was like one of my earliest mentors, and he can make fun of me maybe later where this is not the first iteration of what I did here at Surify. So today Surify is a B2B company, which I'll get into in 1 second, but actually I spent, I think 4 or 5 years on the ground doing different iterations of Surify in the D2C space, or direct to consumer, trying to figure out how to engage consumers on insurance in general. But today, which is where the company's found success and much more success than none in those first years. We are a B2B enterprise technology company selling directly to the big life and annuity carriers, big and small actually, around the country. We've done some little stuff in Japan, but our real dollars and our big accounts are driven through the big and small holders or carriers of life insurance, and then annuities as a subset there. We enable those insurers to sell digitally, whether that's through direct to consumer or their call center or an agent. So that's our Lifetime Acquire. So like everyone's looking at how to digitalize their sales and distribution. The second is called Lifetime Service, which is post-sale. So after someone buys a policy, again, we're vertically focused on life and annuity. The ability to service that policy, whether that's payments, policy updates, beneficiary change, withdrawals, all the things that it takes to actually manage a policy. And thus currently is either done through a call center or a form that someone has to submit. And then lastly, which was actually our entry point in the market, was called Lifetime Engage, which was really seeking to create a relationship or a digital relationship with a policyholder post engagement, which is the big gap here, because usually someone buys from an agent and then gets sent pieces of mail once a year, looking to educate and create a trusted relationship with that policyholder through the life of it. And in life insurance, your average persistency is like 8+ years. So that's what we do. We're a team of 220 people. We actually have some in Silicon Valley, but actually the majority of them are outside. We run a pretty remote culture. We've raised $26 million, and serve some of the big names in insurance like State Farm, AAA, Amica, Bright House, etc.
Great.
That's all I got.
Good. Thanks, Dustin. All right, Max, why don't you give us an overview of Carpe Data?
Sure. My name is Max Drucker. I'm the co-founder and CEO of Carpe Data. And our mission is to create data products very broadly for the insurance industry. Insurers exist and run on data. Insurers are the original data scientists, and we're the original companies doing predictive analytics, predicting outcomes. And Carpe Data serves to provide those elements to enable insurers to make those decisions. Our core use cases really come down to two main purposes. Number one, to automate, and the second is to improve insurance outcomes. And so we leverage new data sources and new data techniques to create data products across the entire policy lifecycle for P&C and life, across all stages and lines of business. Again, very, very broadly. We think of ourselves and want to be the one-stop shop for all things new data for insurance. Examples of the type of data that we leverage are publicly available data on the internet, social media, businesses' websites, areas where people are discussing these businesses. Again, data very, very broadly, data that is not necessarily being exploited for insurance use cases today, but has predictive outcome. We're a company of just under 150 people. We're based in Santa Barbara. We also have a big operation in Lisbon, Portugal, which has been great, and talk about that too, how that's gone for a California company trying to figure out how to do something in another geography. We work with the largest insurers in the U.S. We're mostly U.S. Our customers, our Travelers, Allstate, Hartford, Farmers are examples of the companies we work with.
Great. All right. Well, I guess I'm going to start off with sort of the idea of disruption in general. And this is going to be kind of a two-part question. I'll start with Dustin, but you both have kind of decided to partner with the industry and sort of helping the industry modernize from within, and both on, whether it's use of data or digitizing processes, et cetera. How do you see those kind of full stack insurtechs that have raised a lot of money, seem to make the most news and noise? How do you view what they've built relative to the incumbent firms? Dustin, I'll start with you.
Yeah, I mean, that's a pretty typical over drinks discussion as we laugh about how small the valuations and money we've raised comparatively. So it's always a you got to know, you just kind of accept wherever you go, you get to look at other people and they have different problems. I always like to say, just as one thing, one, we're doing very different things in many cases, and our problems and even the consistency of our valuations and hype has different, like, hockey stick or speed, right? So as a starting point, as Nick says, like, the hype is huge right now in any direct-to-consumer pursuit of the existing insurance market, because that's largely driven through agents and or large building ivory tower insurers and with high fixed costs. The way I see it, though, in most cases, and I'll speak a little more broadly and then happy to answer specifics, is that it's a lot about marketing and growth and growth rate versus let's call it insurance policy, insurance product transformation right now. So I think we're in a phase of, like, largely like attack the growth rates and or the new concepts. And secondly, I think they're very much on the, Blockbuster versus Netflix theory, meaning that it's a distribution way, and there seems to be some efficiencies and capabilities that everyone's chasing. But the I would say in general, the market's been limited in pure product disruption. And that's just what I'll say. That's one, I guess you understand, you can understand my view there by segmenting up. I think the hype and growth rate is something to be more than admired. However, I think the challenge there is a lot of it looks to be more marketing and marketing capability, which is what the world cares about, i.e. sales, than product. And I think that's one debate going on and one way we see it. I think the challenge, I guess one of the critical views is the challenge is, yes, like you're getting 35 times X valuations compared to a major player or more. And the question is, are they holistically or literally changing the business model and or the product, or are they growing? And eventually the hard part for me is when you get to be the size of those players, how do you remedy a 35x when you actually become one of them and who you want to be? And so there's challenges there. I don't think anyone envies those players. Don't envy me for the work we go through or the valuations I get. And I will simultaneously say I don't envy them in the expectations and the challenges they have. So I think there's mutual respect there.
Great. I don't know, Max, do you have any other thoughts along that?
Yeah, I mean, for me, I'm more interested in trying to solve the big problems of how insurers actually get things done. And so we think about impact. And so we like to work with big carriers. The data that we provide, I'm looking to create impact for that carrier in the tens of millions or hundreds of millions or even billions of dollars in some cases. And so to me, those are extremely interesting challenges to be able to drive that efficiency, whether it's through operational efficiency or being able to have additional insights that they didn't have before, relative to, as Dustin was talking about, the new companies are interesting for a lot of different reasons, but they're fundamentally they're still selling the same commodity product as the other carriers are, and so it sets and it's exciting, and they do and in some ways they have a unique advantage because they don't have a legacy history to overcome, and they don't need to they don't have the systems challenges that the major insurers have. But on the other hand, they're still selling roughly the same products. Whereas I think the people on the other side of it, behind the curtains, the enablers, and I would put Carpe Data into that bucket, and certainly Surefine into that bucket, the enablers, that's really where you can drive massive impact. And obviously when you look at written premiums in the US alone of somewhere in $1.5 trillion, there's lots of opportunity to drive a significant operational efficiencies and lift and impact for these carriers.
So I guess I'll kind of touch on this, but do you think insurance companies can do this within and on their own, or in your experience, what's the biggest challenges when you partner with these carriers? Because you both have several marquee names on your bench.
Well, I think it goes back to core competencies, and I think that insurers know what they're good at, and they're good at predicting outcomes. And they're good at marketing, like Geico, for example. They're great at customer acquisition. They know how to do this. They know how to select risks. They know how to price risks. They know how to service those customers and create good experience with the customers. That's what they're great at. What they're not necessarily great at is, because they're not set out to be, is they're not setting out to be a data company, right? They leverage data. They're experts at leveraging data. I think a company like Travelers has more than 1,000 people that fall into the category of being a data engineer, a data scientist, or an actuary, right? So these companies are really good at using data, but they're not really about, they don't want to build technology infrastructures to do something just for themselves. So at least where we think and where we like to sit is we do everything up to the point where then they become the experts. We're the experts at collecting this data. We're the experts at selecting this data. We're the experts at putting this together in a way that's packaged up, so then they can do what they're experts at. And I think that and I think the same is true for various technology platforms and policy admin. It's not really their core competency to create these core systems. It would be wildly inefficient for them to be if they had the infrastructure to build these things from scratch. They probably wouldn't be the most efficient allocation of their resources.
Yeah, it's about data and efficiency, as Max says. If you look at it, the things I want to throw out is, one, the data from the last 40 years is actually why I would say 9 out of 10 insurers today are not choosing to build from within. It's the data that's telling them that, which means I have 40 years of legacy systems and custom this that is holding me back. So I say the two words that Max is hitting on is like, you got to at your own software company, like the very ones that, Max is what, are you software and data? And I don't know how you consider yourself, but
We would call ourselves a data company.
Right.
However, we function as a software company because we create software internally to produce data elements for that insurer to consume. So to the externally, we're a data company, but internally we live and die by a software development lifecycle.
I didn't want to speak. I was just trying to make sure I didn't step on your toes there. And why I just highlight that insurers now, I'd say 9 out of 10 insurers, at least in the area that I work in, and Max, like the big question has been, for the last couple of years as you raise money, is why aren't insurers doing this? And the answer is because it's not the smartest move to do it. Not because they can't. It's not, no one can't do something. It's how much time, money, effort, and distraction it makes to go do that when it's arbitrage for them. If you really look at it, what it's going to cost for them to do and the benefit they're going to get, it's technically arbitrage to look at someone else. That's all they do. So like when someone spends $1 million, I'm going to make it up, I'm just using a number. When someone spends $1 million with me, my challenge to them is, I'll bet you'll spend 5 if you do it yourself. It's a pretty, like, take my word, don't take my word, whatever. Then they go back, and then why they buy is because they realize they spend $4 million less. Like, I mean, so that would be an example. And you do it 10 times over, and they're going to do it once. So, I mean, there's a law of efficiency and learning from your mistakes.
So Dustin, you hit on legacy systems, and you're obviously primarily in life and annuity world. And legacy systems are sort of an anchor for a lot of carriers. Do you feel like carriers should do more partnerships, or should they go for more full upgrades? Should they do hybrid models? What are you seeing carriers doing? What's working, what's not working?
So I'll tell you what they want. What everyone would like to do is whoever just inherited all the crap from 40 years would like to snap their finger, they'd all disappear, and they'd go complete cloud everything. That's what I'm making some assumptions here. That's what I think they'd like to do, or quite a few people would. Brand new stack, textbook called Greenfield approach. That's not what they get to do, though. So the issue is no matter how cloud centric you want, let's just say, like, a lot of times actually there's a company in the life space called Fast or Socotra or EIS is emerging. There's these players, right? They're all these cloud core system providers. Okay. We sit on top of them. We bring an accelerator under our long story. We can launch a full cloud solution, but no one, and we do, by the way. The kicker is no one gets to just do that. That's the problem. So you can like claim this easy, like frictionless path, which is launched, but no one is largely launching a no legacy system reality environments. No, like that's why they're a big insurer, right? They've built up for 100 years or whatever it is. And so what you end up coming, the players that I think, when I don't know, Max probably does a lot of this too. Like we end up becoming really good because we understand that point. We understand that point. We know how to remedy that point, and then we can offer a solution that takes into account their reality. The challenge with InsurTech initially, and sometimes in general, is people promote a pie in the sky theory of what would work if I started today in a Silicon Valley or in Des Moines, Iowa, or wherever room, and we get to do everything from scratch. But that's why you're not $1 billion company. And so I actually think, like I always tell InsurTech founders that are struggling through life like we do, is you're just as much offering software or a data solution as you are offering a trust that you know how to solve the real problem that they have. And I think it's combined with those two.
Anything to add there, Max, on that point?
Yeah, I think I like to use the word seam. It's about being able to identify the right seam for where you can fit in to create the most impact, to add the most value, because they all have different systems. And so for us, like on the claim side, carriers have, wildly different approaches to how they manage their workflow. Some have full claim systems like Guidewire. Others use their document management system. Others are doing some case management that's homegrown. So all these things can be very, very different. to the companies that are enablers like us, we figure out, well, it would be a humongous integration project that you just finished, or you didn't get all the way there over here. So what if we were to do something like create an alert, and that just gets sent as an email, as a PDF that then gets automatically routed to your document management system. It's about it's about being creative to find those solutions. So again, they can get that impact without having to overcome some of these, massive legacy integration challenges.
So Max, I want to kind of relive the panel that we had at ITC or on credit score, and I don't think probably many people on this audience heard much about that, and looking ahead at different risks that what do you see as the risks of using credit score? I know the Commissioner of Washington's emergency rule got tabled by a court recently, but what do you see as sort of the emerging risks of using credit and looking ahead? I know alternatives out there. Just love to hear your perspective on credit score and some way carriers should look at that.
Well, I think the carriers are all at this point have their concerns about their ability to use credit from a regulatory or legal perspective in the coming years. But I think that they're also concerned about the optics issues with it. Insurance carriers don't want to be seen as using something that's perceived to be unfair. But it's a little bit like the prisoner's dilemma. If they're not using credit, but everyone else is, they're going to face adverse selection and have a big problem. Although it is interesting, Nick, I'm not sure if you saw last week, Tesla just launched an insurance product based on the UBI from their own car that allegedly doesn't take into account credit or gender or age.
But why would it need
else.
to? You bought a Tesla. They know it, like, I'm half joking, but dead serious, right? That's total selection bias.
Well, I know. I think it's fascinating. I mean, I can't wait to see what the result is. I know that for me, it's based on safety score. I know for me and my safety score, they wouldn't offer me any coverage. So because I don't know how they did that, but they if you have a Tesla and you have the app, it's tracking, it's telling you. So like my safety score is a 74, and like they show the tiers on how they would price it. Like if you're at 80 or 85 or 90, okay, well I'm not, but that's obviously, to your point, that Dustin, that is the most fair, right? They know how you drive, and the Tesla insurance product will change your premium from month to month. So you drive nice, you get a good price, right? You drive aggressively or whatever that is, right? Your rate goes up, which really is perhaps the most fair way. I'm not sure it's the best consumer friendly. I think people want to know what their insurance monthly.
I don't think that's insurance. I'll joke and say I don't think that's insurance friendly. Actually, I think that sounds more gimmicky to me. And why I'm saying that is if I just binge drink on which I do sometimes on no, I'm half kidding, on like
I've seen it.
My every Sunday once a month, to joke, like I jokingly say, like it's like to charge me nothing and then like charge me a lot, then I have say like they'll probably end up getting screwed. I mean, it's half, well, I at least hanging out with actuaries and underwriters, it does feel like some of these things are attractive, but the risk of it, I don't know. It'll be interesting to see how these products play out, is all I'm saying.
So back to the question about credit, right? There's the two problems of there's the potential regulatory concerns, which we are seeing in some states, or certainly blue states. And then there's the optics issues of insurers using data that is perceived to be unfair. And now we have these alternative forms of data, the data that actually comes from the car, right? That seems like it's pretty fair. It's causal, right? You drive aggressively, hard braking, aggressive turning, whatever, right? Is predictive of accidents. We know this at this point, right? And there's other kinds of data, like the kind of data that we work in that's publicly available, social data. We know that a person that has a strong online presence, for example, is far less likely to commit fraud than someone that doesn't have a strong online presence. So things like that, that's information that a person has control over their own data, and that then could influence their insurance outcomes. It seems like a more fair, more reasonable method. The challenge, though, back to the adverse selection, is that we do know that credit is very predictive. And so the carrier cannot sell insurance without it if everyone else is using it. And so that's why it does need to really happen at a regulatory or legislative level, as opposed to somebody saying, Tesla maybe being the exception, but somebody coming out and saying, okay, we're not using it and we're going to be okay, because otherwise they're very, very likely to face massive adverse selection in relative short period of time.
Isn't that what Loop just did as a like LOOP? Like that's kind of their big value prop, right?
I don't know what Loop does.
Yeah.
Sounds like Nick seen it. Yeah.
Yeah.
I have the hardest thing for me, like I'm not an actuary or an underwriter, I'm just the tech guy, but I always find it as the government removes these capabilities to predict, it's almost, I'll say, because I'm not I'm not doing anything insurance. I feel bad for the insurer because it's just like removing data points that they need. And once again, like the words, I think, Max, what you said is, well, your credit score is predictive. So the hardest part now is like, but we remove it and it's just like, we're removing that. Now we're going to go after something else. And I don't know, it's just interesting to see how, if something, it's like genes, by the way, the same comparison is genes and life insurance for anyone who wants a direct comparison here. It's like, oh, you can't control that your family passed down this gene, and thus we can't use it. And the industry doesn't want to touch that. However, genes are like the most predictive. Like you can have a cigarette hanging out of your mouth for like 100 years, but if your genes are super good, you most likely potentially you won't go down. Yet if my brother-in-law has to really worry about, for example, his heart in health because his father passed early from a heart attack. It's like, so, but we won't use that because it's too predictive potentially.
Yeah, I mean, but that just comes back to what kind of society you want to live in, right? So, I mean, all of that obviously applies to health insurance as well, right? So, pre-existing conditions, to your point, health insurers shouldn't necessarily have to do that because they should be able to get the right price for the risk, is what you're getting at. On the other hand, though, correct. What do you want to live in a society, though, that well, if you didn't win the lottery with your genes or however that is, right? Too bad. It's survival of the fittest, right? And I think on balance, we don't want to live that way. So I think it's a very, very tricky problem, and that's why I think at our panel at ITC with Julie McPeak from Root, she was really making this case on the alternative data that's both predictive and you create is a better approach, right? UBI conceptually really should be the data from the car really should be a better predictor of your accident risk rather than your credit score, which again may be predictive, but you may not have control over because your wife lost her
Max,
job.
Don't blame her.
Or there was a bankruptcy in the family due to some sort of medical bills or something to that capacity, right? Which is not something you necessarily have a lot of control over. So yes, even if that is a predictor of that outcome, I think from an optics perspective, and I think just from a societal perspective, we'd much rather charge a person that accelerates hard and does hard braking more than someone that drives perfectly, because we know that that's going to be the risk is going to be priced accordingly.
So a lot of people think that, and you hear a lot about regulators getting in the way of companies able to innovate and transform. I know you both have experience looking at the AM Best kind of innovation score, and even Max, I know you've talked to several commissioners and regulators over the years. How do you look at regulation and innovation, and do you get a lot of pushback from your carriers around those issues? I'm just curious what you kind of hear. And Max, I guess I'll start with you because you've done the tour of the regulatory community. I know that. So.
That's right. I think really 95% of the carriers you talk to from a regulatory perspective, in the context of auto insurance and auto and home, generally aren't terribly open-minded. They don't want to do anything that might be any bit controversial. There are some carriers that are a little bit more aggressive and saying, if it's predictive, I want to know if it's predictive first, then figure out if I can use it, right? But that's generally not the rule. Usually it's the other way around. Which is interesting because in my experience talking to regulators are pretty open-minded, and that's been my experience when I've met with the commissioners from many other states. They're like, we want to know what's going on. We want to be helpful for big data. We want to see how AI is being used. We just want to make sure that it's fair. But we want to enable insurers to use more predictive data. But it's definitely changing, and it just comes down to insurers also being fast followers, right? We saw this, in the 90s when Progressive understood that credit was predictive, and everybody figured that out. Then they had no choice; they had to use it. Those same trends will also apply. Like, for example, we know that the reputation of a business is indeed the online reputation of a business is indeed predictive of a loss on that business, right? And you can wonder why that is, right? Is it correlative or is it causal? But maybe it's just a proxy for understanding or measuring how well that business is run. And so if a business is run well, it's probably going to have a good reputation, and a well-run business is less likely to have a loss. So you can actually draw some connection there. Well, if this is indeed the case, even if a carrier may not want to use new data or think about things, if this is happening, they're going to face adverse selection because all of those businesses with bad reputations are the smarter carriers are going to avoid those businesses. And so they're going to find their way to those carriers that aren't using this data, and they're going to be upside down in a minute. So it may not be ambitious. The carriers may not necessarily be so ambitious. They have to move to new things out of necessity.
Yeah. Go ahead, Dustin.
I just echo, like, it's funny right now when sorry, I don't mess a lot with regulation, but like what we do on behalf of the carriers touches that. It does feel like the carrier currently and either the legal team, like strictly legal or compliance or around that division, and there's going to be different roles, they are currently holding things up more so than a strict regulation. And specifically, I literally have major carriers doing the exact same thing, and one will get holed up, like roadblocked, and the other will do it and never have an issue. And it has nothing to do with regulators. So I bring that up because there's a fear of lawsuits that, depending on their size, the bigger that they are, they'll fear like outlier lawsuits that, like, for example, a company like Loop doing the whole, like, the insurtechs can mess around because they have nothing to lose. I think in life you see risk changes, as my my uncle and dad told me when I said, oh, I think I should try this. But I'm worried about, and they said, you're worried about what? You have nothing. You have nothing to lose. Like, you are nothing. Go do it. Versus the second you have a $10 billion business, you're a name that you've built over 100 years, they fear what they have to lose, or being targeted when something I'm doing would never be targeted in a million years. They'll get targeted just because it's a lawsuit where someone has to pay a couple million just to even silence a bullshit lawsuit. So I think there's things that the regulators do not seem, and Nick, going back years, you were saying you were definitely progressive on your as a commissioner in your thinking, but then I feel like everyone was like realizing, yeah, this is our industry, we have to be. And now I think there's a lot of legacy and fear in the insurer, not as much the regulator.
I agree. So Max, I got a question I'm going to ask you that's in the chat here. When you think about business reputation as a predictor of success, are you able to share any examples of some of the data sources that could be high value?
Sure. Really depends on the business segment, but if you're looking at, say, restaurants, sources such as Yelp or other Google reviews, where consumers write reviews. And so by using machine learning and other forms of automated data collection technology, you can get a pretty good sense by both the customer rating that they may have given that business, but also the context of what's written in the reviews. They get a good sense on the reputation of this business and other sources where people talk about these businesses. So if these are hotels, that would be someplace like TripAdvisor. If you're for contractors, there's specific sites housed. For lawyers, there's Avvo. Health grades for doctors. These are some of the social sites where you can really get a pretty decent feel for, frankly, the reputation. So for us, what we've done specifically is we've broken the online presence into 5 different indexes. So we have a reputation index, we have a customer rating index, we have a visibility. How much do they market? How much do they tweet? What sort of online presence do they have? Property and safety. Are people talking about this, looks like this, or this is a problem? And health and sanitation. What are people saying? What is out there on this? So we built these indexes so you can really measure business A versus business B, right? And tune that by geography. Restaurants in Des Moines may have a different scale than restaurants in Seattle, because that's just the very nature of those local communities. And so by tuning by business segment, tuning by geography, you can really get that segmentation. So I can really understand what that reputation or what the visibility is between Joe's Cafe and Harry's Cafe. And then I can see how that performs over time. How are these reputations changing? Is if the reputation of a business is potentially plummeting, that could be a sign of a problem. And that what might give an insurer an opportunity to do something about that. They can reach out, they can maybe take another look at renewal or however that is. And so, I mean, the opportunities for leveraging this data to help the insurer predict those outcomes is massive.
So same person asked another question here. So when you consider personal attributes as predictors, what implications are the privacy regulations, GDPR or others, likely to have on the ability to use that data? And I know you are looking at Europe as an entry market, Max. So the question really is around personal attributes and personalized data, I think, and how you would use that or not use it.
Yeah, it's a big question. It's a tricky one, right? Of course, now it depends on what you're going to do with the data. So, and for us strategically, we started in claims as opposed to starting on pricing and underwriting for personal lines, because when a person submits a claim, they're effectively signing off on use whatever you can find on me in order to pay this claim. Whereas on the front end for pricing and underwriting, you're going to face the Fair Credit Reporting Act and a multitude of other regulatory and privacy regulations. So where we come from, or where we stand, our position is largely something that's publicly available. And that person has signed off on that being able to be used as something that can be used as a given predictor. I think where we would like to draw the line, where I think is a healthy place to draw a line, are things that people have control over versus things that they don't have control over. So a person has control over their online presence and what they choose to promote or put out there. Well, that's like going into a job interview wearing a t-shirt or wearing a hat, or whether that's applying for insurance. If you go to buy insurance and you smell of alcohol, well, the agent probably shouldn't sell you that insurance policy. So that's really where you sort of look to really draw that line. Now, as a company, and we do have business in the UK, we do adhere very strictly to the GDPR. Again, our products are on the claim side, and CCPA here in California, and ultimately to consider that to be a helpful competitive advantage for us versus other insurtech or newer startups, because this stuff's hard. We're SOC 2, Type 2 compliant. We adhere to the regulatory requirements. It's expensive. And it's hard, but it's critical, obviously, if we want to be in the space.
Max, isn't the big thing there too, like the easiest way to look at it, and I think Nick used to teach me about this, is like it's all about asking too, right? Isn't the biggest, at the end of the day, people get confused with data, or what I've heard of at least, and seen maybe, is that people are confused with like data you request versus data you just go get. So for example, if I'm like browsing your website and all of a sudden you somehow go pull my hip, you launch a request for my health information without my knowledge or something, like that would be very different than like anything I ask you for and I'm transparent about. That changes the whole game, right? Is that a fair statement? Or because I think people, even GDPR and the emerging US stuff, as Ed's commenting on here, is all about knowledge and knowing what you're doing and what's being tracked and what's being given versus like not having knowledge of it. And I think that's I think that's why insurance, in my opinion, is potentially won't be as affected potentially on these, because we try, at least from what I see, life insurers in particular, we do a really good job asking and trying to make it damn clear what we're asking for. And thus we can get around some of that that very personal stuff. Now tell me.
Yeah,
I'm wrong.
I think that's right. I mean, yeah, the word's consent, right? And obviously, and in the claim side, right? By when you file a claim, you're giving complete consent, just like obviously on a life insurance application, you need to give consent because that data that they're going and getting on your behalf, right, is highly sensitive for what that is. So it just is about the documentation, providing that, obtaining that correct consent. But I think it still doesn't. I think people understand a little bit more in life insurance. You need this information because, you know, you're predicting when I'm going to die. I think that for personal lines products like auto and home, if it's not directly causal or correlative, that's where people. So it's not just getting the consent. It's well, but why do you need to know my credit score, or why do you need to, you know, understand this other thing that I deem to be personal in order to give me a quote on my auto insurance? I think that's where I think it could be controversial, and great care needs to be taken.
See, both of you have partnered with, again, some of the largest insurance companies in the United States and been doing this for a while. I'm going to ask you kind of a curveball question. Let's say instead of running your company, you're running one of these insurance companies you partner with. What would you be doing in the next 2 to 3 years? You know, what if you were running one of these larger carriers or any carrier for that matter, what would you be focusing on going ahead if you were on the other side of the equation? Dustin, I'll start with you.
It's loaded because depending on the line of work and the technology, I mean, it's a loaded question. I think one of the things, let me just talk about what we're seeing. One, everything takes longer to do. So one of the biggest, I'm on a webinar, guys. Sorry, kids are popped in. So for starters, they got to get started. And why I'm saying that is, one, technology and data, from my perspective, is like the day it goes live, literally, is the day you actually learn even one thing. And so the kicker here that I see is some insurers are sitting back and they need to get through, they need to set proper expectations of going through the pitfalls, even getting to a point of what I would call understanding and assessment. And I think some of them really struggle to launch. They don't go far enough down. They think of POC or whatever, but they're kind of stuck and they're never going to get there. And those are the ones that most likely or could get eaten. The other thing I want to comment, and maybe along the same lines, is there is an aspect of a chassis that must be built to do futuristic things. So I always say one of my problems initially was I was walking in showing them a flying car, but there was no roads up there. And so you're sitting there like showcasing this really sexy, cool thing, but there's no infrastructure to support it, i.e. almost like the electric vehicle infrastructure that doesn't exist. So you could literally offer the best, like the Rivian's having that issue where, or from what I understand, like the problem now isn't these cars, it's actually like infrastructure. And I think the biggest thing that the insurer needs to do is make sure they're setting up a base level chassis or foundation for future moves, or they're so far behind. Like they're going to think they need to build electric car, but actually the problem that Rivian and Tesla are solving, for example, may be the infrastructure that's really going to make or break them. And I think like whether you look at embedded insurance or some of these other, or like even data collection, right? If you don't have an ingestion capability or a distribution or some chassis, you actually are more screwed than you think, because that may be the bigger problem. I know it's kind of vague, but I'm trying to sum in quite a few lines of business here. But I see this with like embedded insurance as this new hot topic. And it's like, but they don't even have the ability to sell something not embedded. So how the hell are they going to embed?
Good point, man. I don't know, Max, I put your CEO of an insurance company hat on. What would you be working on and doing the next couple of years?
I think my approach, my answer would be maybe a little higher level. I mean, I think I would be focusing on automating, right? And I look at auto insurance as the model. Auto insurance is effectively 100% automated. But what made that possible? Obviously, they required to think about it, but what made it possible was the data, right? It was the motor vehicle report, it was the loss history report, and it was the automated credit scores. Those three things, and being able to automate that is what made this possible. And so, if I was an insurer, I would look at all my other lines and understand what are these pieces, so I could automate this, so I can build towards getting to where auto is, because that's obviously a product that really scales. The second thing that I would do, because I think it's frankly is really interesting, is I would look at product innovation. And I think that a lot of products that are sold are still too complex. They don't really make any sense. And obviously people understand auto and homeowners insurance, but the amount of people that still, need to use a broker because they don't really understand what insurance isn't. Fundamental insurance really shouldn't be that complicated. But if you're a small business, for example, right, getting insurance is still, you need a BOP policy, and you need a comp, and maybe there's a cyber, and there's all EPLI or all these other given things, right? It's confusing, and you're on different cycles, and maybe your broker, your agent gave you policies with 3 different companies. It's still very, very, very obtuse, and I would love to see carriers really simplify these things and create, like, if you're a nail salon, here's a nail salon policy. And, these are, good, better, best, or however that would be. And I think this applies to other lines, many other lines as well, of just really simplifying the stuff. And in other countries, there's examples where the insurance is different, the policy is different, stuff's a lot more simple. I think really simplifying this would be super interesting, and could be a massive area of growth, certainly in the small commercial space, which has so many businesses don't carry proper insurance. So I think there's huge opportunity there.
Yeah, it's interesting. The biggest risk that people talk about 5-6 years ago was Amazon entering the business, right? That was right. All those. Dustin, we did a webinar on the Amazonification of the industry not that long ago, and if you think about that premise, it's really about direct to the consumer experience. People still talk about Amazon as a big risk to enter the industry, but I guess what are the other risks around consumer experience? Max, you kind of touched on some of this, but you think about part of it is really just the simplification. But I'd love to hear your thoughts around. I think we've kind of moved past Amazon as the quote biggest risk, and now we're looking ahead at that consumer. But how do you view Amazon, these other big tech players? Are they risks, or are they overblown?
Or the other side of it, which people sometimes talk about, is it the OEM, is the car manufacturers? Are they the risk? This is not a new concept, right? Auto manufacturers. GMAC used to sell, there was GMAC insurance, right? And so this is not a new concept, but now we're finally here where it's the technology and kind of the idea. Tesla being a great example of it. You have the app, this is what your price is. You don't need to literally enter any other information to it. I think that if Tesla is successful with their UBI product, I think it's a big problem for insurers, because it's not like Mercedes or BMW or Toyota or GM isn't going to say, wow, okay, this is a business. Why wouldn't we want to be in this business? And it's really easy for us to do it. So I think that would be the biggest threat. I think that insurers should be looking at Tesla very, very, very closely right now in Texas.
It's, to me, it's all pointing to point of sale distribution. So so that's really when people talk about Tesla. I wrote this random blog article called Apple Life, and I like made it look like Apple had launched this life insurance product, and like people were like super interested in it. Well, all this was a while ago, and it was part of like a general thesis I had, but ultimately, like all it was saying is, well, Apple's already sitting in your pocket. Now they know your health info. This is actually before they knew your health info and all that kind of stuff. And if you look at auto, all they're saying is like, what's the most relevant when I'm buying auto insurance? Like, should it be at the dealer, and or, oh, never mind, it should be in the car, right? Or when I'm Amazon, like, you know, Nick and I did a little specific thing on life insurance, and really the question, it's like, yes, we fear Amazon, but we're not fearing. Everyone needs to like when we talk about Amazon, what we're really talking about is distribution. We're talking about point of sale. We're talking about relevant, trusted seller, right? And so that goes back to I think the embedded insurance is a very hot topic, and rightly so. And all that I think embedded insurance is actually saying is, did I get closer to almost like the last foot problem, which is I have the product, I have technology. Now, where is the best place to sell it at the exact time, at the right time? And so that is going to be the good or bad news is the game is just beginning, but two, it's going to be constantly changing in the same way Amazon wasn't the threat before, right? And, you know, Tesla wasn't the threat before, it was online or Geico. And so I think the kicker, this goes back to, in my mind, this goes back to projective, a chassis that can be agile, which is not a common word. I recently had an insurer tell us that we need to stop, like, you guys are like run agile, like we run waterfall. It was kind of this like funny moment. And like they were saying to us, slow the hell down, like, and we're like, no, but we want to, and so you just do what you have to do. But the problem is you have to be agile, because I think it would be bad to suggest exactly how it's going to end. I think it's really important to suggest the value and what and why people are doing what they're doing, because I don't care if it's Amazon or Tesla, or then it's, you know, I don't know, Blue Origin, because everyone's moving to space. Like I need to understand the best way to distribute and or distribute through trusted sources in the way the consumer wants. So I think it's I don't think the game has even but just begun. I think people are like, you know, these topics run in these hype cycles, in which just hype embedded right now is hot, but that doesn't mean it's actually working. I think the premise is quite clear, and I think the end result to me is quite clear, but you need to be ready for that. And that's the deeper questions I'd be asking. Yeah.
Oh, that's good. You know, you guys have both raised millions of dollars. Each of you have quite a few employees in your firms now. So one would argue each of you now are sort of incumbent firms. You know, you've kind of gotten out of the insurtech petting zoo, right? So how do you guys keep your businesses ahead of the competition? Go ahead, Max.
I guess I go first on that. The thing is that now having the credibility and having that success becomes a competitive advantage, and having this knowledge. And I you know, you've heard me say that I feel that one of our key competitive advantages is how well we understand and how well we listen and how well we can navigate the big insurance carrier, right? It's not something you learn in school. It's not something you learn quickly, right? The only way you learn is by getting beat up over years and years and years of understanding who to listen to, how to listen to, what they're really asking for, and then how to then be able to then build products that then they're going to want to use and see, and then sell this vision of this is big impact, right? So I don't really worry that much about a company that starts up tomorrow, because I know it's going to take 3, 4, 5 years to really understand how this works and to really communicate these big impacts, because it's just it's an entirely different language. It's an entirely different skill set. There's no course in class to really figure out how to navigate insurance, and it's different than other industries, right? Because at one insurer, the decision maker may be the chief claims officer. At another place, the CIO might have more of a role. At another place, it may be, it could come out of finance. I mean, it can, these things in knowing how to read the tea leaves and understand how to find that to be able to get your message across and create that impact. It's just hard. So that's how we stay ahead, is by listening and knowing how to navigate.
Good. All right, Dustin, how about you?
Yeah, I think there's the beauty of B2B companies versus D2C, which is the elusive consumer, which is all of us. Why do we do what we do is like art, science, and, other outside influences. When it comes to B2B, the beauty and why I love B2B is exactly what Max is saying. Like, if you're not spending a ton of time with your prospective or real client, then you're making the fatal mistake of building something potentially known would ever user buy. Now, that's not to say in the famous, saying of, I don't know if it was Jobs or whatever about, you ask somebody, that drives a horse and buggy, how to go faster, and they want a faster horse, right? And so there is so the truth is you have to, like, hopefully if you're building a company or you're attempting to stay ahead, you have a creative side and a projective side that's really looking at trends and realities of the way you conduct your life or businesses work. And I think that's where you're balancing. They want a faster horse, which ultimately means they want to move from here to there in a shorter amount of time. So now you have to ask, like, what are the contributing factors now that would give them that capability? For Jobs, right? He looked at X, and Tesla looks at Y. I think for us, I think we have factors that are pressing on the insurance space. They currently run through this archaic path, and we need to be in the weeds looking at that road, realizing, or the gas, and realizing we could set up, the Tesla charging station and saying, but how do we get them there? So I think there's definitely art and science involved, but Max and I probably know that the right answer always is going to be, you have a buyer in B2B. You have someone that's going to pay real dollars for solutions. So if you're going to sell them something innovative or disruptive, they better think they built it, number one, or devised that idea. Because if you walk in showing them flying cars, but they drive on roads, well, you're going to have the famous most lines of code, which is written and no one actually uses. So I really think there's a lot, like, you learn, you can probably think, I've learned to be quiet in those rooms and listen, or at least even debate with them, so you can figure out what the real need is. But you got to go back and recognize they're your buyer. Who are you building for?
So we got about 2 minutes left. So last question, the name of this is the Drake Risk and Opportunity Forum. So is InsurTech a risk, opportunity, or both? Go ahead, Max.
I don't think InsurTech is a risk at all, right? I think this is the way of the world. This has been the way of the world for 100 years. New technology is about moving forward and enables growth, right? It's all about scale. It's what insurers want. Find the right solutions. Do I think that InsurTechs are going to disrupt the D2C distributors, the big carriers? Probably not. No, I don't think that from that side is a huge risk. But I mean, obviously there's a place for them, because there's a place for hundreds of insurers. There's 1,000 auto insurers. So I mean, I think that there's always room. But I think that so many InsurTechs have exciting creative ideas for one piece of the puzzle, and it's just unlocks many opportunities.
Great. All right, Dustin, got 30 seconds.
It's both. I mean, if there is no lie that there's people working 80, 120 hours a week working to take market share. So you see a lot of investors saying, I'll spend, I'll put in hundreds of millions because I'll get 10x and I'll do my thing. I think insurers need to be active and seek people that are looking to change, because the world is changing. But I think if the insurers do it right and everyone puts a little pip in their step and invests in, like, meeting the demand, they have the ball right now. We have the policyholders in force. We have the cred, but you can easily lose it if you let down your guard. So I think that's where we're at. We're at a turning point.
Great. Well, Dustin, Max, thank you for joining us today, taking some time out of your very busy schedules. The committee and I really appreciate you doing that. And Kevin, I guess you're up to promote the next speakers. We have a few minute break here, but again, guys, thanks you very much for joining us. Kevin, it's all yours now.
Thank you,
Dustin,
Nick.
it was a lot of fun.
Max, Dustin, Nick, thank you very much for an insightful, forward-looking, opportunity-filled perspective on the place you guys play in the overall insurance spectrum. One of the things I really love was that comment about legacy systems and insurance companies create seams of opportunity for disruption. And that's something I'll definitely take with me going forward from today. We will take a very short break. We'll be back at 5 minutes after the hour with kind of keying off of this theme of how does technology impact the evolution of decision-making in businesses. So take a quick break and we'll see you back here shortly. Thank you.